Michael Simpson, founder and senior instructor for the National Commercial Real Estate Association. I was a residential real estate agent. I did 100 deals a year based out of Long Beach, California. When one of my clients came to me and said, "Hey, Michael, can you help me do this commercial deal?" One of my residential clients came to me and asked if I could help him do this commercial deal. And so I said what most agents would say to that, which is, "Yeah, sure, I can help you do that." And then I kind of really fumbled my way through it because I didn't know what I was doing. I was using the comparable approach to determine value, and in commercial real estate, we use the income approach to determine value. But I didn't know how to do that, and that's what I mean by saying I fumbled my way through it. And I didn't know, what a cap rate was. I didn't know how to calculate a cap rate. I didn't know if it was a good deal or not a good deal. So that's why I say I fumbled my way through it. Probably shouldn't have done that, but I did. And I ended up closing that deal. And the thing I did is I contacted some of my commercial buddies in around Long Beach and I said, "Hey, help me do this commercial deal." And they said no. I contacted three of them and all of them said no. They said, "Michael, you're the residential guy. We're the commercial guy. You can't do both. Do one or the other. Just refer it to us." Maybe some of you guys have heard that, but I didn't want to refer it. I didn't want to just give up the commission and refer it to them. So that's why I struggled. That's why I fumbled my way through it because I wanted to learn and I wanted to earn the money. So I closed that deal. By the way, that deal was a $52,000 commission. Today, that deal would be $250,000 commission. It was the biggest check I'd seen. I was getting checks that were, the size of about 3 to 5 thousand at the time. This was the early 90s, and my average sales price in Long Beach, west side of Long Beach, was $125,000. So my commissions were about $3 to 5 thousand. So when I got this one, it was like, whoa, wait, you can do one commercial deal and get $52,000, or you can do 15 houses and go through all the work that's involved with that. So the light bulbs were going on for me when I was closing this deal. I also discovered that commercial real estate is much more logical. It's much more 9 to 5, Monday through Friday. It's not so emotional like the residential space can be. Residential can be so emotional, right? People change their minds because of babies and kids and divorces and job transfers and all those things. It's just super emotional sometimes. So I was kind of over that at that point, and I was ready for something more, something more logical, more 9 to 5, Monday through Friday. I was doing open houses every weekend. In commercial, we don't do that. The buyers, we don't drive them around in our cars in commercial real estate. They go look at the stock properties, and when they want to get inside, then they contact us. Or if they want to write an offer or LOI, then they contact us at that point, right? So I like that about commercial real estate versus residential. So those were some things that I noticed when I was doing this commercial deal. Of course, the commissions, I could literally sit here and show you a webinar for 3 hours on just commissions and people who've gotten big, fat, juicy checks. But it would be like a real tacky webinar, wouldn't it? So, but there's certainly a lot of people who've gone through commercial real estate and gone through our real estate courses and things like that that are now doing really well in commercial real estate. So uh, I closed that deal and light bulbs were going up and then off. And then I got a flyer in my mailbox and it was a Remax office. I was at Remax Real Estate Specialists in Long Beach, Bob Stallings' office, for those of you who might be familiar. And a flyer came in and it was like for some commercial training. And I was like, this is a sign that this is where I need to be. So I took this class and it was 3 hours long, twice a week, 6 months. 3 hours long, twice a week, 6 months. So it was a real intense course. And the instructor could tell I was super excited because it was really all I could think about was commercial real estate at that point. And he could tell. And so he called me after the class. He said, "Hey, Michael, if you come over to my office and help me build a commercial division, I'll mentor you." So I thought, wow, what a great opportunity. So I go over to his office, Remax College Park in Seal Beach, and started helping him build a commercial division while I was doing my residential deals. And that was my first real look at a commercial division, from the corporate company standpoint. This was the 90s. There weren't really any commercial divisions yet like there are today. And so I did that. And then I was introduced to Keller Williams in July 2002. And I opened up a Keller Williams franchise in October 2002 in Long Beach. And then we opened up a second one and a third one, grew to about 600 agents. And then actually right during COVID, I sold everything and got completely out of the of the residential franchise business, which I'm really glad I did because I don't really like the way the residential business is heading, the direction it's going, not good in my opinion, with NAR changes and then the fighting and arguing over the inventory. I think when we when we gave our data listings that you guys all work hard for to get, we give them to Zillow or give them to Realtor.com, and they give them to companies, and then those companies turn around and sell the listings back to us and we pay for the leads. It's like that doesn't make any sense. And it's just not a good direction where we've gone with residential real estate. I think the writing's on the wall. I really do for that industry in the next 5 to 10 years between AI, Google, MLS, Elon Musk, MLS, Amazon, MLS. Everyone wants our listings. Everyone wants that information. And frankly, there's a lot of people that think we don't deserve to get paid what we get when we do a deal. So there's a lot of people after us right now, and I just think in time they're going to win. Uh, maybe not in our lifetime here, I don't know, but it's the writing's on the wall for that. So anyway, I'm glad that I'm not really in that space anymore. Is the message, is the point that I'm sharing with you. Commercial, it's much different. Commercial, we don't offer commissions, so we didn't have the NAR drama. We control our inventory unless some of those vehicles that we use in commercials end up selling out, like a lot of the other residential entities did. Uh, the deals are done off market a lot in commercial. You may have heard of that, how a lot of the deals are done off market. So because of all those things, it gives us a lot more flexibility to control our environment. So I sold everything and started doing training when I had the KW franchise. That's what really triggered the training. And I started teaching my classes for commercial real estate. And people started showing up and just growing, 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 and growing, and growing. Well, we've done probably tens of thousands, maybe even hundreds of thousands of these courses now. All of it was live prior to COVID. And then now we do still some live classes. We do some virtual Zooms and things like that, or we'll do a little bit of hybrid. I'm also a master scuba diver, had the dream job of working at the aquarium in the Pacific in Long Beach until COVID shut that down. Got to do all these shows and presentations to the kids and all of the adult kids. We love to travel. So my wife, Angie, um, Greece, Italy, Spain, Ireland, Scotland, Bahamas. I mean, it's what drives us is travel. We did a wonderful safari trip to Africa. Africa last year was just absolutely incredible. This is my daughter, Bethany. She got a great job after graduating from UC Davis and bought a house all on her own money and didn't have to bother mom and dad for it. She's also my scuba buddy. So we get to do daddy-daughter dates together when we travel. This is the favorite in the house, the dog, the pup, Marley. So I always like to share just a little bit about why I'm here, frankly, because this is what drives me. But it also is so that, people like to work with people they know, like, and trust. So you can learn a little bit about me by me sharing some of this stuff. But enough of that. Let's get down to business. Now, how many of you have ever been to any of my classes? If you've ever been to a commercial training event with Michael Simpson or the NCREA, put it in the chat and let me know that you took a class and what it was. It was a 2 hour, it was a 1 day, it was a 3 day. Is there anybody in the room who has been through my class? Any of them? So if I don't see anybody put anything in the chat, then that means you have not been through my class. And so I'll assume that no one's been through the class. The more I know about you, I can't see you, I don't know who's out there. The more I find out about you, the more I learn about you, then the more I can customize my class for you. So that's why I'm asking that question. In fact, I'm going to ask a lot of questions from you This is, it's really hard to teach math and formulas and calculations. If you don't respond to me, I have no idea if you're getting it, right? So um, if you guys don't say, yeah, I got it, or here's my number, I got this number, I got that number, or I'm stuck, I just keep going. And I'll be done in about an hour and a half, which maybe you like, but you will not get your questions answered. And I'm going to leave a lot of you stuck going, wait, I don't understand any of this. So it's up to you to kind of say, hey, whoa, wait, can you explain that again? I'm not getting that. I'm not following that, which, by the way, is very normal. This is complicated stuff. But as I'm saying things and giving you information, talk to me. Tell me, yeah, I got it. We can take you off mute. You can type it in the chat, but talk with me so that I know that you're there and that you're getting it. The more of you that do that, by the way, the more I know, okay, great, they're with me. Let me just keep going. Okay. Otherwise, I'm gonna be like, hey, are you guys getting this? Are you with me? Are you still there? Okay. So it's real important that you engage and play. Okay. Some of our classes like this, we're doing nothing but math and formulas and calculations. So I'm not getting into, language of the investor or what you say to a commercial broker or any of the stuff really in commercial real estate. This is just nothing more than math, formulas, calculations. And when we do these types of classes, we rely on the glossary of terms a lot, the terminology page, glossary of terms, terminology page. And this is in your handout. And you can see that a lot of the formulas and calculations are in here. NOI divided by cap rate, NOI divided by sales price, GRM, so debt coverage ratio. So as you're doing the exercises, this is going to be very helpful for you to flow back to it and lean on the glossary of terms. Now, I'm going to point out this one to you because this is where people get stuck a lot. So look at my screen. Oh, it helps if I share the screen. Uh, Look at the screen, and you can see that ROI, this is one that people get stuck in a lot of times. Cash flow divided by down payment. Cash flow divided by down payment. Okay, at the very top of the terminology page, and I wasn't sharing the screen when I was talking about this earlier. So glossary of terms, terminology page, okay? Cap rate, NOI divided by sales price, GRM, debt coverage ratio. So all the things we're going to do today are in here in your terminology glossary of terms. And again, look at the screen, look at the screen, look at the screen, because a lot of people get stuck on this one, ROI, cash flow divided by down payment. So someone will say, hey, how do I do the ROI again, return on investment? Right there, cash flow divided by down payment. Okay, every agent should know how to calculate a return on investment. So we'll talk about that. We'll talk about what's a good return, what's not a good return, how you know if it's a good return, what's a good cap rate, how do you know if it's a good cap rate, all that stuff. Okay, so I'm getting ready to get into the numbers with you heavy. And again, I just want to warn you that this is fast and I go quickly through it. So it's hard to follow unless you are focused. So get off your phones, get off your email, sit down, pull the car over, do whatever you got to do if you want to learn this, okay? Scale of 1 to 10, where would you rate yourselves on numbers? Everybody put a number in the chat. What is your number? Scale of 1 to 10. One, that's a safe environment, so no one cares, right? And we're all here to learn. So whatever your number is what it is. 1, 0, 0 is I have no idea what I'm looking at here for numbers. 10 is I know those numbers real well. I can do them in my sleep, and then everything in between. Okay. So give me your number. This will help me with pace. Your number, a scale of 1 to 10. 9. Nice, Parisa. So 9, then Parisa, you probably are a commercial broker. You've probably done some commercial deals. Oh, no, you changed it to 5. Okay. So I see 1, 2, 3 of you've got a number for me. What's your number? The scope. Sorry, I didn't understand the scope. What is your number on a scale of 1 to 10? 1 is I don't know anything about those numbers at all, and 10 is I can do them in my sleep. So Diana, go ahead and how do we take Diana off mute so she can talk? Beatrice, 8. So I see that Diana raised her hand. So Diana's got her hand up. Michelle or somebody, how do I take her off mute? Or are you guys doing that? Elsie, Michelle.
I think we both did, and I'm sorry, I didn't mute.
What? Diana, can you take yourself off mute? Elsie, are you there?
Yes, I am unmuting her, but
Oh, okay. So that's something you
it's
control is their mute. So if somebody raises their hand, then I'm just going to stop and say, ask you to take them off mute. Is that how you want me to do this?
yeah, she's unmuted. Diana, can you speak?
Diana, go ahead. Can't hear you. Okay. So I'm not sure. Maybe there's something going on with her sound. Go ahead.
Can you hear me? Can
Yeah.
you hear me?
Go
No,
ahead.
you can hear me?
Yes.
Okay.
Yeah.
I'm sorry, I didn't mean to put my hand up. I was just putting I was a five.
Oh, okay. Got you.
Sorry
Okay.
about that. Sorry,
Yeah, no
Michael.
worries. Yeah, so you guys, if you do that, if you didn't actually raise your hand, didn't mean to, just put in the chat. No, I didn't mean to. Uh okay, so that's good. Thanks for putting your number. Thank you, Elsie. Thanks for putting your number in the chat. Um, I say Beatrice is an eight. Now then also let me know if you have ever done a commercial deal. Okay, so like Beatrice, if you're an eight, you probably have done a commercial deal, is what I'm guessing. Marguerite, possibly too. So if I've ever done if I've ever done a commercial deal, put yes, commercial deal in the chat as well. Okay, so while you're doing that, I'll keep going. All right. Assumptions can be any scenario that you want to show somebody. Let's say that a buyer says, hey, what's the deal look like if I pay all cash? That's an assumption. Here, let me show you. What's the deal look like if I put down 50%? That's an assumption. Here, let me show you. Okay, so these are assumptions. And the assumptions can be current rents, market rents, seller carry, seller financing. Assumptions, GRM 8.44, cap rate 7.31. Where would I go for the formula and definition of these? I'm going to go to the glossary of terms, the terminology page. GRM, sales price divided by SGI. Cap rate, NOI divided by sales price. Okay, so that's what the glossary of terms is where we go when we get stuck, whenever we need to do the next step. Then we're going to go to the price of 750,000. I'm going to plug that into my calculator. I'm going to multiply it times 25%, and that's where I'm getting 187.5. Then I'm going to subtract it. I'm going to take 750,000, subtract 187.5, and what's left over is my first trust deed of 562,500. First loan amount, the loan amount. Then I'm going to amortize this loan, in this case, over 30 years at 9% interest, and that's where I'm getting my debt service payment, which I'll give you in these classes are your payments. Now, right away, right out of the gates, we recognize something that's not normal. So in residential, we call our payments what? We call them mortgage payments. Here we call them debt service payments. Okay, so be careful with your language. This is a class where I'm not teaching you language, but obviously language is critical because if I'm talking to a commercial investor, all their lives they've never bought or sold anything but commercial. And I say, well, looks like your mortgage payment is going to be about that much. What did I just do? Well, I'm speaking the wrong language. So we want to use debt service and speak the language that these investors use. Now, if enough of you put Capital Crunch in the chat, I'll explain Capital Crunch. If you don't know what Capital Crunch means and you want me to cover it, put Capital Crunch in the chat. And if enough of you put that in the chat, then I'll cover it. If if not enough of you don't, then I'll assume you already know what it is or you don't want to know what that is. Capital crunch. These loans are amortized over not over 30 years in commercial real estate. They're amortized over typically 20 or 25 years. Okay. So if you think about that for a minute, um, when Trump proposed that 50-year amortization period idea, uh, whether you're for it or against it isn't the point. It's that you know what it's going to do. It would make the payments lower, and then but it would also give the buyer more time to pay it off. It would take them longer because you're paying more interest, right? So sometimes people will get a 15-year loan, 1.5, instead of a 30, as you're probably aware of. Why do they do that? Well, because they want to pay it off sooner, and their loan is going to, but their payment's going to be higher when they do that. So same thing here in commercial. We're amortizing the loans over typically 20, maybe 25 years, not 30. Okay. But the big difference is that it's usually due in 10, 7, 5, or 3. So the loan is usually due in 10, 7, 5, or 3 years with a balloon payment. And then the interest rate will change based on the loan period. So it might be a 20-year loan amortized over 20 years, due in 10 years at 7% interest, for example. But if they did a 20-year loan due in 3 years, it might be 5%. So they'll reward the borrower for getting a shorter term of loan with a better interest rate. Okay, so the loans are due in 10, 7, 5, or 3. And that's how those commercial loans work. Okay, and then I see that a handful of you have put Capital Crunch in the chat. So if you think about this for a minute, this loan here, for example, is let's say it's 20 years, but it's due in 10 years, 7, 5, or 3, and the interest rate will change based on the term. So let's say that I get a 20-year loan due in 5 years, and I got the loan right around COVID. What was my interest rate around COVID? It was about 4%, 3.9, somewhere in there, right? So you're going to learn today how a lender looks at the deal and how they determine if they'll do the loan or not. And one of the things that we're talking about here is we're talking about how the lender in commercial collateralizes the building, the property, the asset, where in residential, they collateralize me, the borrower, my history, my credit, my income, those kinds of things. Well, that's residential 1 to 4, and then 5 and up, we move to commercial. So now they're not looking at me so much. They're looking at the property, the asset, and saying, hey, does this property perform? Is it conforming? Is it having enough cash flow? See, that's what they're looking at. So, uh, uh, at the 4% interest rate that I got the loan for 5 years ago, I got it at 4%. The loan amount was here. And so it was performing, it was conforming, right? So let's say today, what's my interest rate going to be? Well, it's going to be 6, 6.5. So that loan is going to pop up here because I haven't paid down much interest yet. So it's not going to be conforming or performing. Let's say, for example, there's only one way for me to get the loan amount down to where it's performing and conforming. What's that one way? There's only one way for me to get the loan amount down to where the loan is performing. And there's only one way to do it. What's the only way for me to do that? Anybody want to take a stab at that? What that one way is? I'll give you a hint. It's in the name that we put in the chat or that you guys all typed. More money down. So more money down is the only way that we can do that. And then we put more money in, and then the loan amount is the same, or the loan amount is now conforming. So think about this for a second. How many buyers, how about you, if you've ever refinanced a property, how do you like refinancing the property and bringing money in at the same time? You don't like that, right? And in some cases, we may not have it. So the investor may say, gosh, I don't even have it. $2 million, I got to come in with this. I don't have it. So it's called capital crunch. So it's adding to a little bit of the compounding to a little bit of some of the challenge that we're having with some of this commercial space out there um, with financing in commercial real estate. We're still kind of rebounding from COVID, especially some of the major metropolitan cities and areas, Chicago, LA, Irvine, Seattle, the major metropolitan cities are still struggling a little bit from that. So that's capital crunch. Did I explain that okay? Any questions on that? Okay, great. So now we're going to keep going then. That was capital crunch. That's how loans are a little different than residential. Now, by the way, that's an investor loan, the loan I just explained. If it's an owner user where someone's going to occupy the space, let's say I don't want to lease my space anymore and I want to own a building instead or own a property, I can buy it, move my business in, occupy 51% or more of the space, and I can get an SBA loan, a small business administration loan. And then the lender looks at that as owner user versus investor. Okay. Less risk when it's an owner user, or just like owner occupied and residential, less risk to the lender. I can get a better loan, 10% down, maybe even 5% down. SBA, I can get better financing, fully amortized loans. So those are two different buyers. Okay. One buyer is an investor, and another buyer is an owner user. And those are two different scenarios. And you want to handle those two buyers differently. Those would not be handled the same way in my suggestion. Now, hey, by the way, full disclosure, I want to mention to you guys that this course, I put this course together. So I do a lot of classes. We have we are a training company. I'm a broker, like I said, but I started training a long time ago and launched a company called the NCREA. And we do a lot of training for boards and offices and all kinds of things. We've done classes for Remax and Century 21 and most firms at the corporate level. EXP, I was responsible for helping James Wong, my good buddy, launch the commercial division there at EXP. I did all the training for them when we launched. We had thousands of people in the world there when in the beginning. I remember that, but we did certification training where we give certifications and designations. And when I was doing this, the company will hire me and say, "Hey, can you come in and do this? And we'll pay you, Michael, to do it this way or that way, right?" And so I'll make these arrangements and agreements, and I'll go in and do these training events for these firms. And one thing I was discovering is when they wanted me to come in and do the 3 day, a lot of the agents were lost with the math and the formulas and calculations in the 3 day. And so we were bogged down with people not understanding. And so rather than being able to talk about, hey, what is a good cap rate? What is a good return? How do I know? How do I market for listings? We were talking more about numbers and math, and here's how you do it. So it dawned on me that if I did a prep class for the 3 day, they would come through and they'd already have some basic fundamental training under their belt for the formulas, calculations, and numbers. So this class was born because of that. And this class has just exploded with popularity. Well, everyone wants to take this class, and so we do it a lot, probably every month, maybe every other month, and sometimes it's live, sometimes it's virtual. But it's really a prep class. There's not a lot of flow to it. I'm not teaching you a lot for language and things like that. It's just here's numbers, here's math, here's formulas, calculations. So it's prepping you for the 3 day. And then now what happens is people show up in the 3 day and they're much better at being able to say, okay, I get this. Now tell me how, again, whether this is a good deal or not, right? And they can have the real meat conversation that they're looking for, which we'll talk about today as well. But that's just full disclosure on why we put this class together, was a prep class for the 3 day. Okay. So I just wanted to mention that to you. Okay, so now let's go here to the income. We're taking the income and we are starting with the income, scheduled gross income. And I'll stop every now and then. I'll look at the chat and see if you guys have any questions. And I will also ask, if you want to come off mute and ask me a question. Sometimes it's easier just to say it than it is to type it. And so we'll do that when we need to. Hey, by the way, also what I'm doing here is I'm working really on the buyer side of the transaction in the beginning, I'm going to go through some numbers with you right now, and then I'm going to give you some exercises, and I'm going to say, okay, your turn. Let's go through this together. Put your answers in the chat, and we'll walk through the numbers together. It's critical that you participate with me at that point. And then I'll move to the seller side of the transaction, and we'll end with the seller side of the transaction. I need the class. It's hard for me to get it done in 3 hours, uh, honestly, but I will jam through it with you and get it done in 3 hours. And I always try to get out early, but it just is too much to try to do. So I'll take it right to the end of the course. Okay. But the best part is really at the end there when I get to the selling side. That's the most unique part of this class where most people have never seen that kind of information. So it's pretty good. So that's just the agenda. Okay. So scheduled gross income is coming from the property. I'm going to ask the owner for their rents, for their copies of their leases, for copies of rent rolls. I don't want them to just say, well, it's somewhere around this. No, I'd really want that information so I can look and see exactly what's going on. Schedule gross income. Then I'm going to plug in my calculator, multiply it times 5%. That's going to give me my vacancy factor of 4,442. And I'm going to subtract it. 88,830, subtract 4,442 gives me 84,388 gross operating income. Then I'm going to take the gross operating income, GOI, times 35%, and that's where I'm getting my expense factor of 29,535. Then I'm going to subtract it. 84,388, subtract 29,530. Sorry, that loves to jump like that. 84,388, subtract 29,535 gives me my net operating income of 54,852. So you can see what we're doing is we're just calculating the vacancy factor, then we're subtracting the vacancy factor. Then we're calculating the expense factor, then we're subtracting the expense factor to get to my net operating income. Then I'm going to subtract my debt service payment, and hopefully I've got some reasonable cash flow. And you can say in this case, we don't really have any cash flow. It's $540 per year. So that's how we're doing that, okay? Let's go to the next column. Any questions on what I just said before I do that? Let's see here. Okay, no questions. Moving on. Then we're going to go to the next column. And what we're doing is we're looking to see if I can raise rents. Is there upside? So what we should do, you guys, is when you get numbers from a commercial broker or an owner, first thing I want to know is this actual numbers you're showing me. Is this currently the way the property is operating? Is this actually happening? Or is this some sort of market projection, pro forma? Now it's okay for it to be market projection pro forma, which means when the buyer buys it or you buy it, uh, we're not doing this now, but when you buy it, you can do it this way. So that's okay. That's very common. But the first thing we want to do is say, well, if it can be done, why aren't you doing it, right? And how am I supposed to do it if you're not doing it now? People in strict rent control areas like LA County have done this for years. And they'll say, oh, well, the exit cap is pro forma cap is this or that. And I'll say, well, how are we supposed to do that? Well, you can get the tenants out. How are we going to get the tenants out exactly? Well, there's workarounds, like what? So it's very difficult sometimes when there's rent control or when it's fully occupied and the rents are low. Why are you selling it on pro forma? How are you going to do that? See, so these are the things that you want to question. But we always want to know, are this is currently happening or actually happening? Okay. So, and then I want to look and say, okay, if this is how it's currently happening or actually happening, what could it be? What could the upside be? One of the things I've noticed a lot, big time since COVID, is I've seen people lose their shirts, lose their tails, lose their whats, because something happened and they invested and it didn't go the way they thought, didn't work out the way they thought. So not only am I looking to see is there upside, but I'm looking to see is there potential, pitfalls or is there downside to this? Things that I'm not thinking about looking at here that might come up and cause me to start losing money. So is there upside? Is there downside? Upside, easy to kind of see. Rents, are they low? I'm going to do a rent survey. I'm going to do a lease survey. So in the 3-day class, I'll show you how to do that. Let's say that you go, okay, yeah, it looks like the rents are a little low, and I could raise the rents. Wonder what the numbers would look like if I raise the rents. So then we look at the numbers if we raise the rents. We're going to do the same thing. 101,000 times 5% gives me 5,000. 101,000 subtract 5,000 gives me 96,000. 96,000 times 35% gives me 33,000. 96,000 subtract 33,000 gives me 62,000. Sorry, this keeps bouncing like that. 96,000 subtract 33,000 gives me 62,000 net operating income. And then 62,000 subtract the debt service payment gives me more cash flow now. And you can see we have more cash flow because we raised the rents. Right? Any questions on that? And I know there's questions because there's questions I always get when I teach this class. So I know there's certain questions that usually come up and should come up, frankly. So you should have questions, you guys. So don't hold back on your questions. Don't be shy. Because remember, if you're thinking it, somebody else in the room is probably thinking it. And then remember what I said, if you really want to learn this, you got to tell me when you have a question or when you're not following something because it's very complex. So there's no way you can take this class and not have any questions at all, in my opinion. Even if you're a full-time commercial broker and a pro, there's going to be a question. So any questions on this? See, look here. Okay. Oh, wait, I think we got one. How do we get to 62,000? 62,000. How did we get to 62? Okay. So we started with 101,000 and then we calculated the 5% vacancy factor that gives us 5,000. Right? And then we're going to subtract it. 101,000 subtract 5,000 gives us 96,000. And then I'm going to take the 96,000 times 35%, and that's where I'm getting 33,000. Then I'm going to take the 96, subtract the 33, and it's going to give me the 62,000. Okay, does that help you? Is that what you were asking? Now also, while you're answering me, remember what we can always do, you guys, NOI. Let's say that Michael's not here or it's after class and I'm trying to figure out my net operating income. I'm going to go to the glossary of terms and I'm going to look up NOI. Oh, there it is. SGI less vacancy and expenses, which is what I just showed you. SGI minus vacancy minus expenses gives me my NOI. Okay, so that glossary of terms is real helpful for your terminology page. The other question that is out there, who can tell me, I'll tell you what, I'll say it like this, is there's two things that cause my vacancy and expense factor to change. What are the two things? Let's see if anybody in the chat answers my question, and then that'll tell me that you guys know this. But you probably don't, and you're not asking the question. You might be being shy. But this question always comes up around, Michael, 5%, 35%. Is that standard? Is that normal? Do you use that all the time? Why are you using that? And that's not getting asked. So I'm asking you, do you already know that? Do you know that when the vacancy and expense factor change and why I'm using those numbers right now? Or you maybe just didn't catch it to ask about it or are being shy. It's one of the above. So write this down. The lender is going to require minimums. Your lender looks at this and requires minimums, right? So they're going to say if it's an apartment, we're going to require a minimum of 5% and a minimum of 35%. Now there's two things that cause my vacancy and expense factor to change. Two things that cause my vacancy and expense factor change. One is the area and two is the product type. Think about it. If we're in Laguna Beach, close to, Irvine, and let's say I go to Irvine, densely populated, lots of traffic, lots of people, lots of cars, lots of demand. maybe not as much supply. So I may not have a 5% vacancy factor. Probably don't if I own 5 units, 10 units. I probably don't have a 5% vacancy factor, but the lender is going to look at it and say, well, if we had to foreclose and take the property back, we need a 5% cushion. So they're going to require a 5% vacancy factor no matter where it is, even if it's a super, super busy area. Now, let's say that we look in Nebraska or Iowa, somewhere like that, densely populated or rural area, cows, farms, dirt roads, things like that. Would the vacancy factor still be 5%? No. We would call the lender to see what we could use, what should use in those areas. Okay, so the lender might say, well, here we're going to use 12, 14, whatever the number is, and then we're going to plug that number in. So whenever we're out of our area or working on a different product type that we're not familiar with and we don't know what to use, we should contact our lender. So it's not going to be 5 and 35 all the time. Area, product type will change my vacancy and my expenses. It will change my expenses. What would be some other things that you guys can think of that would change my expenses? What would be some things that would cause my expense factor to go up? What would be some expense factors to cause what would be some things that would cause my expense factor to go down? What would be some things you could think of? Put it in the chat. Tell me what you can think of that would cause my expense factor to change. Obviously, the area, like I just said, but what else? Think about it. The area, and I'll talk about the area while I'm waiting for you to see what you would put in there. Yeah, very good. So insurance, yeah, insurance is a problem right now, isn't it? There's certain brands of electric panels that aren't insurable at all. So there's things like that are just a big problem right now. There's if it needed a lot of work. A lot of repairs, a lot of deferred maintenance. Yeah, it's very good, Diana. Age of the building, higher tax area, right? All those things are going to impact my expenses. So don't just say, oh, well, it's always 35%. See, that's the point there for expenses. Maybe it's Arizona. Remember, I think it was last year in Arizona and Phoenix. I think it was right around this time they had a heat wave of like 115 degrees for over a month. If you have a big industrial building and you're blowing big AC units all day and all night, you're going to have a spike in your expenses. If it's Chicago and it's a blizzard for a month or a long period of time, the expenses are going to spike. If it's master metered means there's only one meter. All the tenants are getting all their utilities included in the rent. Expenses are going to be higher. They're going to be more like 50%. So there's going to be times when it changes, but it's probably not going to be less than that, less than 35% for a multifamily property. Even if it's brand new construction, the lender's kind of conservative right now. They're probably going to say, well, okay, let you use 25%, but they're still going to underwrite it being very conservative. Area, product type, change my vacancy, change my expense factor. Product type changes my expense factor. What's triple net? What does that mean? Triple net. Anybody want to take a stab at what triple net means? Put it in the chat. Triple net. So I've been talking about multifamily, but what if I have a different product type? Retail, office, industrial, triple net. Triple net, tenant pays taxes, insurance, and maintenance. TIM. Taxes, insurance, maintenance. Single net, tenant pays taxes and rent. Tenant pays taxes and rent. Double net, tenant pays taxes and insurance and rent. Triple net, tenant pays taxes, insurance, rent, and maintenance. TIM. Triple net, tenant pays TIM, taxes, insurance, maintenance. And then an absolute triple net, the tenant's paying everything. Taxes, insurance, maintenance, roof, plumbing, heating, electrical. So the difference between an absolute triple net and a triple net is night and day. But let's say it's triple net and the tenant's paying tax, insurance, and maintenance. I have a listing appointment. Would I put 35% in here? Probably not. Who would I call to find out what I should use? The lender. So I call the lender and I'm going to get the number from the lender. Okay, so let's say they say 10%. I plug 10% in there. Then I go on my listing appointment and the owner says it's triple net. Michael, why are you using 10%? Well, we want to analyze the property through the eyes of the lender, and they're probably going to want to get financing. So we should look at it the same way that the lender is going to look at it. So I'm teaching you guys how to underwrite deals. You want to take these numbers and underwrite it. Don't just run with the numbers. Take it and say, okay, what is it what is it going to be when the buyer buys it? Don't just say, well, here's the way it's operating now. Here's the way it's going to look when the buyer buys it. Okay, underwrite the property, underwrite the deal. How are you guys doing on the math? Are you following me with the math when I went through that? Are you understanding me? Are you with me on that? I'm going to give you an exercise coming up. And so if you're not with me, it's normal for you to not be with me, not really follow it, because it's hard to learn when I'm just saying, take this, multiply it times that, subtract it from that. When you'll really get it is on the next page when I go into exercises and I say, okay, your turn. And then you plug it into the calculator and you go, oh, okay, I see why he's saying this. Okay, so that'll help you if you're not following the numbers real well. ROI. So we talked about cash flow and we stopped here at cash flow and we said, okay, now we have more cash flow because we raised rents. So how do we calculate return on investment? If we know once we get to the cash flow, we're going to go to the glossary of terms, cash flow divided by down payment. Oh, okay. Cash flow, plug in my calculator, divided by the down payment. You guys can do this with me if you want. 8117, put it in my calculator, divided by 187.5, slide the decimal place 2 places to the right because I'm converting it to a percentage, and that's how I get the return. You also need to convert the cap rate as well. So you're going to slide that decimal place 2 places to the right when you do that because it's a percentage. So you have to either slide the decimal place 2 places to the right or multiply times 100 to get it to convert to the percentage. But that's how we would do the debt coverage rate, the return on investment, and the cap rate. Debt coverage ratio. Debt coverage ratio is lender jargon for will I do the loan or not? So when I first did this, the lender said it was 1.0, and the lender said, no, it needs to be 1.1 or higher, Michael. And what does that mean? Well, it means column one, there wasn't enough cash flow for them to do the loan. Column two, there was enough cash flow for them to do the loan. Okay, so debt coverage ratio, DCR, debt service coverage ratio, DSCR, is a lender jargon for whether they'll do the loan or not. Today's world, the debt coverage ratio is 1.25 or higher, 1.25 or higher. When you guys go to our 3-day class, I'll give you a pyramid of risk, and it looks like this, where at the bottom you have apartments, and then it goes office, and then it goes industrial, retail, office. I'm sorry, apartments, office, industrial, retail, hard money, and land. And the higher you go up that pyramid, the more riskier it is to the lender. So the higher the debt coverage ratio is probably going to be. So 1.25 is the minimum debt coverage ratio for multifamily. Other product types is probably going to be a little higher. Okay, so 1.25 minimum debt coverage ratio. Why is this important to you? Because when you get numbers, when you get the deal, you guys have to just take a look at it quickly. You know, the lenders aren't going to do all this for you. You've got, especially not until you have a reasonable relationship with them, and then they're busy. In time, you'll be able to zip through these columns like this in 5 minutes, 2 minutes. We're also going to use software and spreadsheets and things like that once we really understand the numbers. But what you do is you get them and you take a look at them real quick and you say, oh my gosh, debt coverage ratio is not high enough. How am I going to get the debt coverage ratio up? Because if the ratio is not high enough, the lender's not going to loan. If the lender's not going to loan, then I'm probably not going to be able to close. And if we're not going to be able to close, then I'm not going to get paid. And if I'm not going to get paid, I don't want to do the deal, right? Because this is not the nonprofit real estate class. This is getting paid for what we do, right? So if we're not going to get paid, there's no point. So if you can't get a loan and the buyer can't pay all cash, then you're not going to close. So the debt coverage ratio is really important. So what are the 3 ways to raise my debt coverage ratio? If I'm here and I need to get to here, what would be 3 ways for me to do that? What are 3 ways to raise the debt coverage ratio? Put it in the chat, guys. 3 ways to raise the debt coverage ratio. Three ways. Guess. Put it in the chat. Talk to me. And then Pat, while they're doing that, 3 ways to get more income over here so that I can raise my debt coverage ratio. There, nice. Okay, Julie, great job. More money down. That's great. Yep, that's one way. There's 2 other ways, folks. And then Pat, can you repeat out the calculated return? Yes. So take 8117, go to your glossary of terms for everything. Glossary of terms, ROI, cash flow divided by down payment. Oh, okay. 8117, plug in my calculator, divide it by the down payment, excuse me, 187.5, slide the decimal place 2 places to the right, and that's where you're getting 4.3%. The cap rate, we go back to the glossary of terms, NOI divided by sales price. Oh, okay, I see. NOI, 62,429, plug in my calculator, divided by the sales price, 750, slide the decimal place 2 places to the right, and that gives me 8.32. And that's how you do that. Great job, Pat, asking the question. Look, you guys, if you come through this class and you sit there stuck and you go, well, I'm not going to ask any questions. I don't get it. I'm stuck. Well, you'll never get it, right? I can never get you past this. And then you can never start doing this. And then you can never start enjoying these nice commissions. On the other hand, if you help me unlock you, if you're sitting there stuck and you say, Michael, I need help on this part, and let me walk you through it, then I can walk you through it. And then all of a sudden, oh, okay, boom, I got it. Now I can keep doing it. Now I understand. Now I got it. Now I did it. And then once you've done it, it's just a matter of repetition. And then once you keep doing it over and over again, you're going to get really good, guys. And what happens is people call you, they seek you out. They say, hey, think about it. There's not a lot of people that know how to do this at a real high level. So if you get really good at this, when you get really good at this, you can really do well with it because there's not a lot of people that know how to do this. And there's a lot of people who need help. I get calls, I get emails. I mean, it's like nonstop now for some reason. Hey, can you take a look at this deal, Michael? Can you take a look at that deal? I kind of want your opinion on it, right? So people will seek you out at a really high level, but you got to go through the pain and the agony, and you got to pay the price to a certain degree. The price is your time, practicing, maybe taking classes that are not free. That's what I mean by that. So it's well worth it though once you've done those things. So good job, Pat, on asking the question. So 3 ways to raise the debt coverage ratio: more money down, lower price, seller financing. More money down. So I'll put this in the chat. More money down, lower price, seller financing. That's it. Those are the only 3 ways to do it. So if you can't do one or more of those ways, then you don't have a deal and you probably should move on to something else. The reason that raising rents isn't going to work, a lot of times people will say, raise rents. And by the way, you guys, I like to ask questions and I like to ask you to participate, because what happens is if I just, I've been teaching and doing this for a long, long time. And when I'm live, I can look and walk around and I can see, okay, you're stuck here. Let me help you. Right. But here I can't do that. But I like to ask questions, because if I just sit here and talk, what happens is people start going wah, 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 and then they start tuning me out, right? I start losing you. Where if I ask questions, it stops your brain and you start thinking, wait a minute, what did you just say? Usually it's like, wait, what was that question again? Because I wasn't listening, right? And then your brain starts going, what's the answer? So this is how I like to teach, is by asking lots of questions. So the more you participate with your answers, I think the more you'll get out of it at the end of the day. So more money down, lower price, seller financing are the only 3 ways to do it. So a lot of times people will say, well, we could just raise rents and we can get more income. would you rather loan me money? If you're the bank, would you loan me $3 million based on what I say I'm going to do in the future or based on what I've done historically? And the answer is historically, right? So lenders are not going to loan on forecasted rents or markets or projections. They don't like to do that. The exception to that might be if, so a lot of investors have relationships with banks and title companies and escrow companies, and home inspectors and things like that. They have their own people. So they may have a bank relationship where they go, look, I've got 5 loans with you. You see how I operate. You saw how I turn those other 2 properties around. This is what I'm going to do here. And they may say, okay, yeah, we'll go ahead and look at it. We'll do the appraisal. We'll do a rent survey, lease survey, and see if those numbers make sense. And then they may go ahead and do it. But that's the exception, not the rule. Okay. So we want to operate efficiently as owners so that when it comes down to refinancing and short term 10, 7, 5, or 3, or selling, we can maximize our value or maximize our ability to refi. But it's also why lenders will not loan against it. And so the only 3 ways to raise the debt coverage ratio: more money down, lower price, seller financing. So I'm sitting here at 1.1, and I can't do this deal. It's not going to work. I can't get paid. Oh my gosh, what am I going to do? Well, let's see. Will the buyer put down more money? No, buyer doesn't have any more money. Okay. Will the seller lower the price? No, seller's not going to lower the price. Will the seller do any financing? No, seller's not going to do any financing. Well, we've got a dead deal, right? We don't have a deal. So sometimes a deal is dead and we move on. But Michael, I really, really need this commission. Sometimes a deal is dead. Okay. You hearing me? Sometimes a deal is dead. And it's easy to get excited in commercial, but Michael, they've got $50 million to invest, right? But they're not serious. Or, Michael, it's a great deal. I'm going to make, $150,000 commission. Yeah, but you can't, the deal's dead. There's no financing available. The deal's, yeah, but I'm going to make 100. No, you're not, not on this. Sometimes the deal is dead. Okay. So it's a quick, easy way to look at it and see if you want to move forward or not. Any questions on that? Let me know if there's any questions. Seller financing, put in the chat SF or SC if you've ever done a deal with seller financing. In fact, put in the chat if you want me to cover seller financing. No, Michael, I already know all that. Don't worry about it. Uh, uh, don't worry about it. You can go on to something else. Or yes, please cover seller financing. So tell me what you guys want me to do there with that. I'll give you a second. Okay. Has anybody ever done any seller finance? So I got one person to respond to my question about seller financing. So do you guys, the rest of you don't want me to cover it? 2 people have asked me to cover it. So the rest of you guys don't already know it? Okay. Yeah, that's what I'm wondering. Is there anybody who's ever done seller financing or it in the room? See, sometimes I'll have a room and they're like, oh yeah, we know that. And then I'm like, okay, I won't really go into it much. So I'll go through it since several of you have put yes. Okay. So price is $1 million and the seller's carrying 10%. So you got to work with me here. Help me out here. Talk to me. The price is $1 million. Seller's carrying 10%. How much is the note on my second? I want you to think and respond. Price is $1 million. Seller's carrying 10%. How much is the note on my second? Price is $1 million. Seller's carrying 10%. How much is the note on my second? So that's the first, Marguerite. So the first would be 90,000. So the second would be 10, right? 10,000. So the price is $1 million. Seller's carrying 10%. So you're asking me to loan the buyer $100,000. That's essentially what we're doing. Okay. So if the buyer's, someone calls and says, hey, will your seller carry 20% and the price is $1 million, we're just taking a percentage of the sales price. So 20% of $1 million is 200,000. Okay. So that's how you do that. So let's say the note is 100,000, 10%. And then the question is, okay, I'll loan it to you, but what interest rate? It's usually interest only that we do those types of loans, interest only. So if I say I'll do it at 10%, how much is my payment? if the note is 100,000 and the interest rate's 10%, how much is the note on my, how much is the payment, I'm sorry, on my second? What's 10% of 100,000? Good. Percent 10,000. So that's how I'm going to do it. If the note, so all we're doing is take the note times the interest rate, and that's the payment. Okay, so 100,000 times 10% is 10,000 per year, divided by 12 gives me my monthly payment. So that's how you do interest only payments, and it's pretty straightforward, pretty simple way to do it. And what we did here is the owner said, Michael, I asked him, will you consider financing or carrying? And he said, I've heard about that, but can you go over that for me and explain how that works? So what we did here is we rate, and he said, why should I do that? Because I'm familiar with it, but why should I do that? Well, here what we'll do is we'll raise the price. As long as the market will bear, we'll raise that price, 750 to 810. And we'll pay you 11% on your money. Where can you make 11% on your money? Not a lot of places. So the owner loved the deal because we got a better price and he got all of his money except the $210,000 at the closing. And then we paid him 11% on his money that he borrowed, loaned to the borrower. The buyer loved the deal because the buyer got in with only 20% down. And because we deferred the payment, so I just told you how to do the payments. In this case, we deferred that payment. So we said, look, you'll earn interest, but you're not going to earn it every year. So 210,000 times 11% is $23,000 and some change. So year one, $23,000 is due, but it was deferred. Year two, $23,000 is due, but it's deferred. Year three, $23,000 is due, but it's deferred. And then at the end of the 3 years, all three of those payments are due along with the $210,000 in the form of a balloon payment. So you see the buyer loved the deal, the owner loved the deal, everybody loved the deal. The buyer loved it because he was able to defer those payments and it gave him all this cash flow to go in and look at his return jump up, and the stabilize the asset, gave him the opportunity to go in, increase the rents, stabilize it, increase the occupancy, fix it up, do all the things they need to do, and then refinance or sell this property 3 years later. Okay, so it was a great way to do that. Everybody won in that deal. There certainly is risk to the owner. What's the risk to the owner? The risk to the owner is that the buyer doesn't pay the note back in 3 years when it's due. So we want to make sure the buyer's coming in 30% down today's market. I feel a little bit more comfortable with 30% down. 20% is probably not enough. 30% down, debt coverage ratio meeting the criteria for the lender and the product type, and then the lender's going to be okay with it, and I'd probably be okay with it as well. Okay, so that's seller financing and how that works and what we did there. Any questions on that? Let's see here. Any questions? What can the seller do if the buyer doesn't pay? So 3 years later, if the buyer doesn't pay, we can foreclose, or the owner, previous owner, can foreclose, take the property back and sell it again for a second profit, which I've actually done. But that's also why there's some risk there, is that if the buyer only has 20% of the game, 10% of the game, and things get tough, it's really easy to walk away. Where if the buyer's got 30%, 40% in the skin in the game, and things get tough, they're going to figure out a way to hang in there and not lose the property. But that would be the option for the owner. So a lot of this depends too on how this owner feels about the market and the future of the market, right? So I'm going to ask the owner, hey, how do you feel about the market? Like if I'm selling a retail building in Long Beach, and I'm going to say, hey, how do you feel about the retail market in the next 5 to 7 years? Because if that owner doesn't feel real strong about the market, not what I think, but what does the owner think? If the owner doesn't think the market's going to be real strong in 5 years, well, then I'm going to say, look, then you may not want to do this, right? Because that buyer doesn't pay you back in 5 years. All you can do is foreclose and take the property back, and the market may not be there to support you for that. On the other hand, if the owner says, oh man, the market's going to be really strong and I wish I wasn't selling this, well, then I'd say, well, then you may want to go ahead and do this, because if the buyer doesn't pay you back in 3 years, you can foreclose and take the property back and have a second profit on it. So it really depends on how that owner feels with the future and the market, because it's their money and it's, I'm just giving them pros and cons. Okay, so good question. All right, I don't see any other questions, so keep them rolling here. Let's do an exercise together. Now, the part for you to learn, if you're not familiar with this, if your number is not a 10, and by the way, if I come to you and I say, hey, I've got $5 million I need to place, and I'm hiring you, I'd like you to help me, what number would I expect you to be at on a scale of 1 to 10? Well, 12, right? If you're handling my money, how much should be at a 12? So that's the number we all should be at, is like 12. So our goal should be to get to a 12. Okay. If you're not a 12 in the room, which I didn't see any 10s or 12s in the room, if you're not, the key to this is doing this work right now, is plugging these numbers in. If you're just sitting there watching me and you're like twiddling your thumbs or driving around or walking around the office or car, it's not really how you're going to learn. You've got to do it with me. Got to actually do the numbers with me and work with me here on this. There's no other way to really dig in and learn this. Okay, so all I'm doing here is, uh, and again, the more you respond in the chat, the more I can say, okay, everyone's got it and move on. Price is 2 million, 25% down. The scheduled income is 200,000, and the debt service payment I'm giving to you, and I've just plugged them in here. So the first step is real easy, and you can see there's a blank right here for you to be able to plug in the answers, or you can plug in the answers here, or you could just literally take a piece of paper and go like this on a piece of paper. The price is 2 million. The down payment's 500,000. First thing we're gonna do is take and subtract 2 million from 500,000. And that's my first trust deed. So what is that answer? 2 million, subtract 500,000. What's your answer? Put it in the chat, raise your hand, we take you off mute, whatever works. Good. Good job, Marguerite. Good. 1.5, you guys. That's an easy one, right? So everybody should be typing 1.5. Thanks for participating there. 1.5. That's an easy step. Okay. And then I know that you got it. So I'm going to move on. 200,000 is my SGI. Now, where's that number coming from? Michael, where'd you get that number again? 200,000. Where am I getting that number? I'm getting it from the property itself. So I'm saying, hey, what are all the leases added up monthly times 12? What's the income of the asset, right? If I don't have that, I'm stuck. I can't really get anywhere without it. So 200,000, what's the first thing I'm going to do? I'm going to take it times 5%. So everybody take 200,000 times 5% and tell me what you get. 200,000 times 5%. Put it in the chat. Tell me what you get. Are you guys all doing this with me? Are you doing the exercises? Good, Julie. So I see a couple of you are putting it in the chat. By the way, Marguerite, yes, the holder of the second has to bring the first current if that's behind as well, then foreclose. 10,000. Okay, so a couple of you are putting this in there. So what about the rest of you? Are you guys with me here? There's 20 of us in the room, so and really two are putting numbers in the chat. So are you guys with me? Am I losing you? There's 15 of us in the room. 200,000 times 5%. It's pretty simple, but I don't want to lose you. Are you guys with me? Marguerite's got it. Julie, nice. Parisa, nice. Is anybody lost on that step? 200,000 times 5% gives me 10,000. Okay, thanks, Christine. I'm going to move on. Then 200,000 times 5% is 10,000. Okay, that's pretty straightforward. Then I'm going to subtract it. 200,000, subtract 10,000 gives me my gross operating income of how much? 200,000, subtract 10,000 gives me 190,000. So everybody should write gross operating income, 190,000. Then I'm going to take 190,000 times 35%, and that's going to give me my expense factor. 190,000 times 35% is going to give me my expense factor. Good. Parisa, 66.5. So everyone should be writing 66.5. Now, see what I'm saying? Don't, sometimes in classes, people are slow, people are fast, people are everything in between. Don't just look at the answer and say, okay, that's my answer, because you're not learning it that way. You really want to go step by step so that you can learn how to do this. 190,000, subtract 66.5 gives me my net operating income. Now, if you guys are like, hey, Michael, I got it. I'm familiar with this, or I'm pretty good with numbers. I don't want to go so slow. Go ahead. Just go ahead and do the whole thing. Go all the way to the bottom. And when you are done, put your return on investment in the chat, and then I know you're done. Don't forget your GRM and CAP at the top. You can use your glossary of terms if you're stuck to fill in the blanks. So I'm going to let you go and go for it. And when you're done, put the answer in the chat. And I'll just do it that way right now. I'm going to let you see how you guys are doing. And if you're stuck, say, hey, whoa, wait, I'm stuck. Raise my hand or put it in the chat that you're stuck, and I'll walk you through it or help you unlock you. Okay. But it sounds like you guys are all following it and you're with me and you're good. So I'm just going to let you go. Go ahead and do this whole exercise. And then when you're done, put the answer in the chat below. Put the return in the chat below. And then I know you're done. So I'll just give you a couple minutes to do that. Just reach out if you have any questions or put in the chat if you have a question. So it's key now, isn't it? It's key that you guys all say, hey, the answer, my return is this, so that I know you're done. Otherwise, we'll sit here for an hour, right? And we don't want to do that. So tell me if you're done or if you're stuck. Put the answer in the chat, put the return in the chat when you're done. Anybody have any questions? Anybody stuck? So I gave you debt service payment, Parisa. So it's right here. Okay, so you guys already have the debt service payment. Don't sit there stuck. If you guys are stuck, just say, hey, all you got to do is say, hey, Michael, can you go over that again? And I'll just go through it and walk you through it. You don't see it, Diana. So this is it right here. See the screen? See the 119,754? You guys are just looking at my screen, hopefully, right? 119,754. That's the debt service payment. Diana, you're doing great. You've got your NOI. So now all you need to do is take your NOI. It's too little to see. Oh, that's the kind of feedback we need right there, right? That's good feedback. How's that? Does that help? Yes, Pat. Elsie is recording it, and I don't know if she's going to fire it out to everybody automatically or not. I'll let her answer that, but I know she's recording it. Welcome. You guys doing okay? Just working it? Are you working it or are you stuck? Are you done? Talk to me. Where did you get the debt payment of 119? So this is the debt service payment. So this is based on this loan of 1.5 amortized over 30 years at 7% interest. That's where I'm getting the debt service payment. You guys want me to give you a couple more minutes? Tell me what you're doing, guys. Talk to me. I need you to talk to me. We just need a couple more minutes? Are you working it? Are you stuck? Technical difficulty. Thank you for enlarged screen, but I had to enlarge mine. It's no, I can only see small. No, it's too big. I can only see a small portion. So, all right, let me do that. Is that better? Diana Perna. So I'm not sure what that number is. Okay, let's walk through it. Okay, here we go. 200,000. So this part's pretty straightforward. 2 million times 25% gives me 500,000. 2 million subtract 500,000 gives me 1,000,005. You're funny. So 200,000 times 5% gives me 10,000. 200,000 subtract 10,000 gives me 190. 190 times 35% gives me 66.5. 190 subtract 66.5 gives me 123.5. 123.5 subtract my debt service payment gives me 37.46. And there's my return on investment right there. And then the GRM and the cap are on the top. And then I'm going to go to the glossary of terms for those formulas. Oh, that's right. ROI, cash flow divided by down payment. Then I slide the decimal place 2 places to the right. Then for my GRM and cap at the top, I'm going to go to the glossary of terms. GRM, sales price divided by SGI. Cap rate, NOI divided by sales price. And that's how I'm doing the GRM and the cap. Okay, so I'm going to give you guys just another minute. I don't know, if you're done or if you're stuck or if you're just working it, you just need another minute, or if you're with me, I don't know, because you guys aren't really responding. So I need you to, so I'm just going to give you I'm just going to assume you need a little bit more time. You want to work on it in a couple minutes. And when you're done, put the return on investment in the chat, and then I know you're done. Debt coverage ratio, how to calculate cash flow. Okay, Blair, good question. And then Marguerite. So how to calculate cash flow. So cash flow, I'm going to go to the glossary of terms and NOI subtract debt service. So then I take the NOI of 123.5, subtract the debt service, and boom, there's the cash flow. Marguerite, stuck on debt coverage ratio. So you guys remember the glossary of terms will unstick you. Debt coverage ratio. I'm going to go to the glossary of terms and the debt coverage ratio, NOI divided by debt service. So then I say, oh, okay, great. So then I go back to the spreadsheet and I say NOI, plug in my calculator, divided by debt service, 1.03. Nice work on asking the questions. Good job. Okay, so talk to me, folks. You guys good? You need another minute? I'll tell you what, I'm gonna give you just 60 seconds. I'm gonna walk away from the screen and I'll come right back. When you're done, put done in the chat. Okay, so I know you guys are done, meaning I've done the whole thing. And if you don't put done, then I'm gonna assume that you're still working on it. Okay. Nice, Parisa. Be right back. How we doing, guys? So I got one done. I have one person that's done. So you guys are still working it? Or are you there? Are you done? What's going on? Let's see. Two done. Okay. Are the rest of you guys still, are you still working on it? Stuck. Diana's stuck. Okay. Okay. So I'll go through it again and then I'm not sure if everyone is stuck other than a handful. 200,000 times 5% gives me 10,000. Are you with me there on that? 200,000 subtract 10,000 gives me 190. 190 times 35% gives me 66.5. 190 subtract 66.5 gives me 123.5. And the key to this The absolute key to this, you guys, is one step at a time, meaning literally like this. And if I don't do this first step, 200,000 times 5% to get 10,000, I can't do any of the other steps. So you've got to go like one step at a time so that you can get to the next step. But it's critical that you do the first step, that you actually do it. Don't just watch, but actually do it. 200,000 times 10 times 5% gives me 10,000. 200,000 subtract 10,000 gives me 190. 190 times 35% gives me 66.5. 190 subtract 66.5 gives me 123.5. 123.5 subtract the debt service gives me 37.46. Cash flow divided by down payment is the formula for ROI. So I take cash flow, plug in my calculator, divide it by down payment of 500,000, slide the decimal place 2 places to the right, and that's where I'm getting 0.75. Okay, then I go to the glossary of terms for my GRM, my cap, and my debt coverage ratio as well. Now, there's another exercise here for you guys to practice. The key to this is going to be you doing this and practicing on your own time. How many of you will practice this? How many of you will give me in the chat? Promise me that you will chat, that you'll promise you'll chat. Promise me that you'll practice. There's the exercise, there's the blanks here. There's the income. Here's the information. And you're going to use that same format to plug in the blanks, and the blanks or answers are right behind you. Okay, so the key to that is practicing so you go step by step. And in no time, I can pretty much assure you that you will be going, okay, zip, 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 zip. And then once you're doing zip, 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 then you can work with customers and do these types of transactions. And again, the demand is pretty high for these types of transactions. Okay, so is that helpful for you? You guys doing okay? I see one person put practice in the chat. Yes, two people. Okay, great. Julie and Marguerite. So we're rocking it. We're knocking it out of the park today. Two of you guys are going to practice this. So when I brought my junior on my team, I just got into commercial real estate, and I was kind of tired of the residential stuff. I didn't want to keep doing it. I was doing 100 deals a year for a long time, and so I was just tired. I was burnt out. And so I didn't want to have anything to do with it anymore. But I, enjoyed the income coming in from it. And let's face it, the residential feeds the commercial, so I didn't want to give it up. So I was going to bring a junior in to manage the residential division, and I was going to go into commercial. And it was my nephew that I brought in to do this. And my nephew starts seeing my commissions, and he says, I want to learn how to do that, right, in commercial. And so I said, okay, come to the office every morning at 8 o'clock, and I'm going to give you 5 spreadsheets, and I'll just pull them down from Crexi, CoStar, LoopNet, MLS even. And we'll go through all that stuff, what I just said and what that means, and some of the language we use in commercial in the 3-day with you guys. But you can pull sheets like that from anywhere you can get your hands on them and just practice. And so I would give them to him 5 a day. And I said, okay, go do this, 3 columns, 2 columns with each one of those properties and bring them back to me. And then I'll go through it with you. Well, how long did it take him before he's like zip, zip, zip with the numbers? Not very long, because he was practicing on a regular basis. If you end this class today and you go right back to your busy lives and your busy world, how long is this going to stick in your brain? Probably not very long at all. So the key for you is practicing this and really staying with it, right, on a regular basis, staying engaged. So I would encourage you, check out our website. Michelle, if you can hear me, put our website and your email address in the chat for them. And you guys can, check out some of the other classes that we have and do, or reach out if you have questions, and you can attend some of these other classes and stay engaged. That's the key to this, all right? But you'll get, if you really want to learn this and you're serious and committed and willing to practice, you'll learn this at a really high level, and then you'll be able to go zip, zip, zip. Okay. So it's nice to see a couple of you put in the chat that you'll practice. Three of you put in the chat that you'll practice. So the others are just either ignoring me or just not going to put anything in the chat, or you're not going to do it. So, and that's okay. That's up to you guys. So I'm just trying to, be honest with you about what you need to do to really understand this at a high level. All right. Any questions on anything that I've talked about yet? Any of the numbers or anything that we've gone over? All right. So now we're going to look for three numbers. Okay. So when I go pull, let's say that the owner here is wants to sell, wants to have an idea of what the value is, things like that. What I'm going to do is start with the income. So the owner gives me the income, copies of leases, copies of rent rolls. I add them all up times 12. It gives me 153,732. Then I'm going to run the numbers. Okay. All of you guys now have a general understanding of what vacancy and expense factors are, when those numbers change and why. We talked about that. You have an understanding of how to get to the net operating income, NOI. So NOI, you understand how to get to these numbers. So when I pull comps, I'm going to pull comps for three things: the GRM, the cap, the ROI. So if we start with the GRM, I'm going to get the value by multiplying the SGI times the GRM. So I'm going to take SGI times GRM, and boom, that's going to give me a quick and easy way to determine value. Okay. The downside to using the GRM to determining value is that doesn't take into consideration my vacancy and my expenses. The GRM just says, hey, the formula is sales price divided by SGI. Sales price divided by SGI is the formula for GRM. So it doesn't care about my vacancy or expenses. The GRM says, Michael, give me a price and give me the gross income, and I'll give you my number. Well, shouldn't we care about vacancy and expenses? Yeah. So that's the downside to using the GRM, is it doesn't take into consideration vacancy or expenses. The the true accurate way to look at this is using the NOI, because the NOI gives us our cap rate. So the cap rate says the formula is NOI divided by sales price. See the difference there? The GRM is a correlation of price and gross income. The cap rate is a correlation of net income and price. Okay, so the cap rate says, well, give me the income, but back out the vacancy and the expenses, give me your net, and then give me the price, and I'll give you my number. So how would we determine the price, you guys? If I have my NOI and I have the cap rate from the comps, how would I determine the price if I have my NOI and the cap rate? How would I determine the price if I have my NOI and the cap rate from the comps? Because what I'm going to do is I'm going to get the NOI from the income from the owner. I'm going to calculate the NOI. And then once I have the NOI, I'm going to pull comps. Where do we pull comps, Michael? So in the 3-day class, I'll show you where to do that and the tools we use and all that. But I'm looking for cap rates really from those comps. So let's say I pull the comps, and the comps in the area are 6.37. Great. How do I determine the value now that I have my NOI and I have my cap rate? Let's see what you guys are seeing, if anything there in the chat. Good. So Diana, we're going to divide. We're going to take the NOI and divide it by the cap rate. So everybody do this with me. Plug into the chat your answer. Take 96,928, divide it by 6.37 cap rate. Because what Diana just said is that's the formula for determining value. So to determine value, I go to the glossary of terms, and I can use my SGI times my GRM. That's going to give me a quick, easy way to determine value, right? But the downside is it's gross. It doesn't take into consideration vacancy or expenses. So we really want to use the NOI. So everybody do this. NOI divided by cap rate. NOI divided by cap rate. Put your answer in the chat. NOI divided by cap rate. Put your answer in the chat. NOI divided by cap rate. 96,928. Plug it in the calculator. Divide it by 6.37 cap. Put your answer in the chat. 96,928 divided by 6.37 cap. So we have one answer. We'll give you guys just a second to do that. Take NOI, plug in my calculator, divide it by 6.37 cap rate. Okay, good job, Julie. Everybody do that. Let's see how you guys do. Good. Good job at doing the work. Diana, good job. So 1, 2, 3, 4, 5. There we go. We got 5 answers in the chat. Parisa corrected hers. Yeah, you got it. You caught what you needed to do there, didn't you? Good job. I like to see, I like to do it that way so you can kind of go, oh, I see. I need to do it that way, and then it'll sink in, right? And we'll remember it. So how about the rest of you guys? Are you trying it? Are you doing it? Are you sitting there with your hands on your thumbs, or what's up? Are you put 96,928? Yes, it definitely sinks in that way. And divide it by the 6.37 cap rate. Have I lost you, some of the others in the room completely? And you're just disengaged, or I don't know what's going on. Because you're not putting anything in the chat for me here. So I don't know if you're stuck or if you're working on it or you did it. Anybody have any questions on what I just went through? So the way to do it, I think it would be helpful to put the equation next to your chart step by step. Yeah. So 96,928 divided by 0.0637. 96,928 divided by 0.0637. Okay, so that's how you do the math. It's a percentage, so we have to go 0.0637. And when you do that, it's going to give you 1,521,000. Okay, so that's how you do it. You take 96,928 divided by 0.0637. And I've seen students do that, by the way, Christina. I've seen students they'll write the formulas next to their paper or on their book, in their handouts, things like that. But the glossary of terms is also just really super helpful for us because it's got all the formulas and calculations in there. All right, now, that's how we do it. Now, how do I know, by the way, the better the deal for the buyer, the higher or lower the gross rent multiplier. Better the deal for the buyer. What's your answer? Put in the chat. Talk to me. Better the deal for the buyer, the higher or lower the gross rent multiplier. Better the deal for the buyer, the higher or lower, right? The gross rent multiplier. Lower. Another way to look at our GRM is it's the number of years that it takes for me to make my money back. So let's say we buy a property for $1 million and the scheduled gross income is 100,000. The GRM in that scenario is 10, right? Because the gross rent multiplier is sales price divided by SGI. So in that scenario, it's $1 million divided by 100,000. That's at 10 GRM. The other thing that means is it takes me 10 years to make my money back. So year 1, I make 100,000. Year 2, I make 100,000. Year 3, I make 100,000. And then in year 10, I've made my $1 million. What a beautiful reason to own investment property. But do I want it to take 10 years or 7? 7, right? So the better the deal for the buyer, the lower the GRM. The better the deal for the buyer, the higher or lower the cap rate. Higher. So those two are inverse. Which is a truer reflection of value, the GRM or the cap rate? Which is a truer reflection of value, the GRM or the cap rate? The cap rate. Why? Because it takes into consideration vacancy and expenses. The gross rent multiplier is gross. It's just based on the gross income. So your novice investors, your novice, good job, Diana, your novice clients, they're going to use GRM sometimes. But your experienced and savvy investors and brokers, commercial brokers, they don't use GRM at all. Really, we just use cap rate primarily. If the only time we use GRM is maybe multifamily, but even then, we want to use really the cap. So whenever I start talking with somebody, I'm always going to lead with the cap rate. And then if they want to start using price per square foot, cost per door, GRM, or some other methods of determining value or discussing, then I'll have those conversations with them. But you don't want to lead with any of that. I think you lead with the cap rate because otherwise, an experienced investor is thinking, well, why are they doing that? When we use the cap rate. So I'm going to use the cap rate for determining value. Now, how do I know if this is a good deal or not? So I'm looking at this and I say, gosh, wow, okay, how do I know if that's a good deal? Well, I'm going to pull comps. So when I pull comps, I'll go through this with you guys in our 3-day, and I'll show you. I'll put them up on the board, and I'll show you. I'll say, here's where we get these comps, and here's why you can't just rely on these comps. Here's how you go about this, and I'll walk you through it. But if let's say the cap rates are 10, 10, 10, and 10 and 10. Do I want to buy this property if they're 10, 10, and 10 and 10? What would be your answer? Give me an answer. Would I want to buy this property if the cap rates and the comps are 10, 10, 10, and 10? And this is 6. No, right? Because the cap rates are 10 and the comps are 10 and the cap rates are 6. If the cap rates are 2, 2, 2, and 2, then would I want to buy it? Yes, because the better the deal for the buyer, the higher the cap rate. So see what you want to do here, you guys. You want to practice, 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 but then you want to get used to, oh, the value goes up, the cap rate goes down. The cap rate goes up, price goes down. So you want to get really good at that, and get really good at determining value using the NOI and the cap rate. That's where you want to get really strong because we do that over and over and over and over again. So you want to get really good at identifying if it's a good deal or not. Because, again, a buyer, a seller or buyer, they're looking at something, they come to you and they say, hey, how's this look? And you don't have till tomorrow to give them the answer. It's like, well, should I do this or not? Right? They're standing right in front of you or sitting right in front of you in some cases. So you want to get really good at this. So the better the deal for the buyer, the higher the cap rate. Okay. So how do I know if this is a good deal? What are the comps showing? What are the comps showing me? So if I said, hey, Michael, if you said to me, hey, Michael, in Seal Beach, what's this? Well, I know Seal Beach, but let's say we look in a market that I don't know, uh, uh, San Luis Obispo. I don't know that market at all. Let's say that you say, hey, Michael, look at the house there on 123 Main Street in San Luis Obispo. Is that a good deal? What am I going to say? Well, I'm going to say, I don't know. What are the comps showing? Okay. So then I'm gonna look at the comps and I see, oh, this one sold for 4 million, 4 million, 4 million, 4 million. So the value must be somewhere around 4 million, give or take the work it needs and the area and the condition and all that. Same thing here, except we're looking at comps and we're saying, what is the cap rate of those comps? Instead of what's the price, what's the cap rate? And then I'm comparing the asset to the comps to determine if it's market or not, or if it's good deal. Okay, so that's how we're doing that. All right, so good point to ask if there's any questions. What if there's no current comps? Yeah, so if there's no current comps, it's challenging, just like residential, because sometimes there's not a lot of closings, not a lot of activity in that particular area for that particular product type. So I'll go further out, further away from it. I'll go back in time, just like you would with a residential. If it's residential and you're comping a 3-bedroom, 2-bath, there's nothing out there, you might go 4 bedroom, 3 bath, you might do 2 bedroom even and make adjustments. That's what I'm going to have to do here if there's not a lot of data. Good question. Anybody else? Any other questions on any of this that we've covered right here? Okay, so we're going to go to the next column here. And what we're doing is we're raising rents like we've talked about earlier. So we're going to move the scheduled gross income. We're going to do a rent survey, lease survey to see if we can raise rents. And then we say, okay, yeah, those rents are a little low, so we can raise them. And when we do them, here's the value. Here's what the price should be. So if the income goes up, then the price should go up. And that's what you're looking at here. Now, the difference between 1,500,000 and 1,700,000 is about $200,000 and some change. About $200,000 and some change. So have you guys noticed how a lot of times owners tend to keep their rents low? And when they keep their rents low, they don't raise them. Why? Why does an owner not keep their rents at market? They tend to let their rents go and keep them low. What have you heard about that? You guys noticed that or heard that or seen anything with that? Yeah, it's because they want to don't want to have a bunch of turnover, right? And I just don't want to lose my tenants, don't want a bunch of turnover. I love my tenants, love, just the best tenants. Well, do you love them, $200,000 love them? Because that's what you're leaving on the table, right? By not raising these rents. Because remember, the lender's not going to loan against seasoned rent. I mean, the lender wants this seasoned. I think I said that earlier, that word seasoned. That's what they're looking for. They want to make sure the numbers have been operating that way. The property's been operating that way for a year or two. Sometimes lenders are years, sometimes they're 2 years, depending on the lender, but they use the word called seasoned. They want to make sure these numbers are seasoned so we can't loan on forecast or market rents. Uh, so I can't get financing here. I can only get financing based on this amount. And the buyer wants this upside. That's why they're buying it, is for the upside. So the owner says, look, I want the upside. Well, you can't get the upside all the time, especially when the market's kind of flat the way it is now. It's not like it was 5 years ago. 5 years ago, I'd listed at 2 million and it would sell at 2.1. Now, all buyers aren't really going to buy against forecasted rents. They're going to buy and operate based on the way it's operating in most cases. So you got to be careful about this, pricing the property too high based on forecast rents or market rents. The buyer wants the upside. So that's what you're looking at here. Is it normal assumption that expenses are 35, vacancy 3? So, Julie, I don't know if you heard me go through that earlier when we started the class where we talked about the lender having minimums of 5 and 35%, and we had a bit of dialogue about that, but I talked about that earlier and went through it. So I don't want to go back and rehash it, but if you missed it, you'll get the recording. Just watch that little clip. We probably spent 20 minutes or so talking about the vacancy and expense factor and when it changes, but great question. Most leases are at 5 years. That considered seasoned? It depends. If it's considered seasoned for loans, yeah, but if it's at the end of the 5 year term, if this is year four, when we're looking at nets and double nets and single nets and triple nets and leased investments, I'm buying the lease. That's what I'm paying for, is that lease, that income. So if it's coming up, I'm like, oh man, now what? Right? So it could be good because sometimes rents are low. So people will say, okay, well, it's great because I can go in and fix it up, do what I need to do, raise the rents, raise the leases, get more income out of that asset upside. But it also, why am I going to buy a long-term leased investment just for the sake of what I just said, for the long-term return where I don't have to worry about it? So here all of a sudden now next year, if it's due next year or lease is coming up and in year five and it's year four, I've got to worry about these leases and renewing them. Are they going to renew? Can they renew at market? Can they renew? Are they going to want to renew it lower? Is it going to be a big deal? Can I get the space renewed at all, reoccupied at all? all that stuff comes into play. So it really depends on where it is and what it is. Can we get these forms you're showing us? Yeah, we gave you a handout, so you have this actual document that I'm sharing with you right here. If you didn't get the handout, get to Elsie or Michelle, I think is in the room, and she can, either one of them can drop it in the chat for you. Yep, there it is again. So there you go. There's their handout. Any other questions on this? Is it helpful for you? To make sure nothing else. All right, so I'm going to move off this now and go to the seller side of the transaction. Now this gets very complex, this part of it. But again, remember what this is for, you guys. This is for, technically it's for a prep class for the 3-day. So if you go to the 3-day next, what'll happen is you're going to go, okay, I've already got an understanding of this, or just a look. I've got a general, look, so it's not so shocking. Michael's told me to practice. Here's my exercises to practice. So I'm going to practice. I know I don't like to practice on my own, but that's what I need to do. And then I'm going to go to the 3-day, and then Michael's going to give me more exercises and go through it more. Instead of 3 hours, I have 3 days. So I can go through this much more in depth with you and slow it down and explain. And by the way, Christine, I think it was, I actually have those slides in those classes, in that class, with the steps right next to it, the way you suggested. So it is in that one. I may end up adding it on this one. And you're going to get it. And then I'm going to give you more homework to do in that class, and then you'll leave that class going, okay, I got a really good understanding of this. Okay, so that's the purpose of this, and that includes what I'm getting ready to go through with you now, because it's very complex what I'm about to go through with you. Now, what we're doing here is we're dealing with a concept that's called diminishing return on equity, diminishing ROE. And it has to do with the owner sitting on equity of more than 50% loan to value, 50% loan to value. And it applies to a house, it applies to, an apartment, it applies to a hotel, it applies to anything that's an investment property. If I own a house even, and it's a rental property, let's say it's free and clear, my return is probably 2% on that asset, 2% on my house that's a rental property. So is that a good return? 2%? I don't think so. I think I can get better than that in my money market, my high rate money market account, a CD. So why would I have an investment where I'm getting 2%? Well, usually the owner just doesn't know that that's happening because you haven't come along or nobody's come along and pointed this out to them. Think about it. There's a lot of people in that very position, 50% or more are free and clear. Now, if somebody says, hey, I just want to sell, or what do you think the value is? I'm not going to go through this with them. I'm just going to go get together with them, get an appointment, get their income, and then come back and determine the value and give them the presentation and get the listing. Here, though, they're not raising their hand saying, I want to sell. I'm thinking about it. So they're not doing that. They're just out there and I'm targeting them. So this is a form of me lead generating in commercial real estate that we use. Another way of doing that right now are those loans that are coming due. So a lot of us right now we have tools that we use in commercial to pull up people who are with short-term loans that are coming due this year, next year, and then we'll reach out to them and help them before that time happens when their loan comes due. And I tell you, a lot of people are like, "Oh wow, I didn't even know. I forgot because it's I'm busy and I got doing this and that. I wasn't paying attention." So it's a really good way to lead generate uh, for commercial listings. This is a great way to lead generate for commercial listings as well. So this has to do with diminishing return on equity. And as long as I know these things, I can do what I'm going to show you. So as long as I know the price when they bought it 7 years ago and the type of loan they put down 25%. They got a loan at 7% over 30 years. Uh, then I just need to look and see what they're going to sell it for and what the buyer's going to put down when we sell this property. Now I can do this whole analysis So again, this is just an introduction to the analyses that we do in that class. It's not for me to teach you the everything because I can't in this short period of time, but it's like an introduction so you can start practicing and playing with it, whether you're live here right now or whether you're watching this recording later. Sometimes people will watch the recording. The recording is nice because you can stop it and say, wait a minute, and push play and go real slow and stop it and say, okay, let me do what he just said, right? And step by step. That's how some people do this. And that's fine. There's nothing wrong with that. And then when they show up in the 3-day class, they've gone through those processes already. And then it's much easier for them to keep going and do more and more and more of this. And then I'm spending less time talking about numbers and math, and I'm spending more time saying, here's what this means. Here's how you can help somebody achieve their goals faster. Here's how you can get listings, right? Which is why we're all here right now, is so we can actually get paid doing this and help our clients out. So when I was showing you earlier, I was showing you a view of the buyer's debt service payment. So if the buyer buys this property with 25% down, their debt service payment is going to be 82,000. Buyer. Well, now what I'm doing is I'm showing the owner a snapshot of their property and how it's operating. How did your property operate in 2025? So see, what I'm going to do is I'm going to get in front of them and say, look, I can show you how your property is operating, everything you ever wanted to know and more, including your interest paid, principal reduction, and depreciation in 2025. How does that sound to you? And they say, well, yeah, that sounds good. What do I need to do? And I'll say, you don't have to do anything. I'm going to do it all. It's all free and it's part of our service that we provide. And then I'm going to go do the analyses and I'm going to go back and present it to them. And if their return is low, a lot of times people will say, oh my gosh, I didn't know I was so low. What do I do now? And then we exchange into something else. So this is a great approach for getting listings and having these conversations with the owner. But if it's a snapshot of their property, then we're going to need their debt service payment last year. So that's what I'm using right here is their debt service payment. Where am I going to get their debt service payment from? Where am I going to get their debt service payment from? I'm going to get their debt service payment from the mortgage statement. Ideally, I don't want them to just say, well, it's, about this much. I want them to give me the exact number. So they're going to usually, I'm going to get it from the mortgage statement, and then I'm going to write it down. Then I write it down. I take 170, subtract 127, gives me my pre-tax cash flow. Okay, now once I've done that, I have my pre-tax cash flow. Now I need to jump down here to figure out what my taxes are due, what taxes are payable, right? Let's say I take 170, subtract 170, 430, subtract 127, 738, and I get 42,692. Okay, so 42,692 is my pre-tax cash flow. Well, if I make 42,692 a year, I got to pay taxes on that money. So I'm going to have to come down here to calculate how much the taxes would be. So I'm going to start with my gross operating income. I'm going to pull it down from the top, GOI, pull it down and start with GOI, write it down right there. Then I've given you the loan interest that was paid last year. So when we buy a property, as you know, a certain amount of the payment goes to principal and a certain amount goes to interest. All I'm saying is last year, the amount that was paid for interest is 102,184. And I'm going to get that number from the mortgage statement. Okay, so I pull down the GOI from the top. I get the loan interest from the mortgage statement. I'm going to use their actual expenses. Their actual expenses. So I'm just pulling down this number from the top because it's their actual expenses. I'm going to give you a snapshot of your property and show you how it's operating last year. Where would I get depreciation ideally, you guys? If somebody is depreciating their asset a certain amount every year, where would I get that number ideally? Put in the chat. Where would I get somebody's depreciation? Yeah, so they're accountant Marguerite or their Form 1040. So I just meet you, Marguerite, and I say, hey, I can give you an analysis of your property, give you a snapshot of it, show you everything you ever want to know more and more, including your interest paid, principal reduction, depreciation, and taxes paid. All I need is a copy of your Form 1040. You're probably not going to want to give that to me, right? But that's the ideal place to get that. Now, if I'm meeting with an accountant or CPA or somebody who knows what I'm talking about, I'll say, here's what I'm doing. And they know, they understand what I'm talking about. But most people don't have any idea. Your clients are going to have no idea what I'm showing you right now and what I'm talking about, diminishing return. Nobody knows what that means. So this is advanced. What I'm teaching you right here really is. Even in the full-time commercial firms, most of them don't understand this stuff, you guys. So very small percentage of people do. Another reason why you want to learn it and get good at it because you're going to be over here in a unique few that really understand how to do this. You know, who do you know anywhere that says, "Hey, I can help you write a written real estate investment plan. I can help you achieve your goals faster by writing written real estate investment plans." Do you know anybody at all? Any of you guys know anybody anywhere? Have you ever seen that or anybody doing that anywhere? Probably not. If you do, put it in the chat. Yeah, I've seen that, or I've done that, or I know somebody who does that. But I'm guessing there's nobody in this room that has never ever seen that because it's just not very common that anybody is doing that. So it really gives you an opportunity, doesn't it? Because imagine if you show up and you start saying, I'm the guy, I'm the gal that does that, it puts you in this place over here where nobody really is. It's like this, why wouldn't you want to be in that spot? That's why I have had so much success. It's not that I'm smart or super sharp or, any of that stuff. It's just that I've learned this and I implement. I've gone through the pain and agony of learning it and how to get really good with it. And it's a service that is available, and there's just not very many people that know how to do it. So ideally, that's where I get the depreciation from is from the tax roll. I'm sorry, from the accountant or mortgage statement. I'm going to get the depreciation, not from the mortgage statement, I'm sorry, from the tax form or the CPA or accountant. But because most people don't want to give that information out, I'm going to calculate it. So here's how we calculate it. I'm going to use the sales price times, I'm going to use this formula. So I go back to the glossary of terms. You can see where I'm circling here. Sales price times 85% divided by 27.5. Sales price times 85%. So do we depreciate the land or the building? We depreciate the building. So I'm using the straight line method, and we're depreciating the asset over 27 and a half years, which is the depreciation time frame for multifamily. Residential is considered multifamily. So straight line method for depreciation is 27 and a half years. For a house that's a rental property or 2 units or 3 units or 400 units, multifamily is considered residential for this from the standpoint of depreciation. If it's commercial, it's 39. Now, is the sales price of when I bought it, or is the sales price of what I'm selling it for? Is the sales price of when I bought it, or is the sales price of what I'm selling it for? What's your answer? What do you think? Julie, I think, yeah, I see your question about, I assume you're asking what, if you're curious about our 3-day class, would you put it in the chat? 3-day, just put 3-day. If you're curious, if you'd like information on them, when they are, where they are, how much it is, and all that kind of stuff, put 3-day in the chat. And then, if there's a handful, then I can kind of get it to you here just real quick. I won't go through a big, huge, long pitch or anything with you, but I can get you the details, and we'll give you we'll give you an LC price, Orange County Association of Realtors price. It's the price we're buying it for. No, it's the price we're bought, original purchase price. Yeah. So if it's the original purchase price, right? Because when we buy investment property, we get this huge benefit of depreciation. And it's something you guys really want to understand this. Uh, because this is just gold. I mean, this whole diminishing ROE concept is absolute gold. So when we buy real estate, we get to depreciate the asset, and it's a huge benefit that we have for owning investment property. So it's based on when we bought it. Okay. So the formula, sales price times 85% divided by 27.5. When did they buy it? What did they pay for it? So they paid 1,600,000. If you want to do the math, you can. 1,600,000 times 85% divided by 27.5. 1,600,000 times 85% divided by 27.5. That's how I get this number here of 49,454. Okay. Why 85%? We're using 85%, so we're depreciating the building versus the land, and I'm using 85% for the value, where I'm saying 85% of the value is in the building. So that's why I'm using 85%. It could be a little aggressive because a lot of times when we get towards the water and expensive areas, most of the value is in the land. So if somebody ever questioned me, I would say, oh, no problem. What do you want me to use? Because it's not going to have a big difference in the outcome. You know, a lot of times you'll see on your property profiles, your tax assessors, tax rolls, you'll see 70-30, 80-20, 85-15. Maybe you've noticed this. That's your land to building ratio. That's why I'm using that. So good question. So Blair and Marguerite, I just answered that. Hopefully you understood what I'm saying there. Cool. Good to see you guys asking questions. Let me know if you have anything else. So then once I've got the depreciation in, guys, now if you follow me on this, I tend to lose people on this part. I'm just going to subtract. That's all I'm going to do here. So I'm taking the GOI, I just got that from the top, and I subtracted the loan interest, subtracted the expenses, subtracted the depreciation, and it gave me 18,792. 18,790. So if I have taxable income now after depreciation of 18,792, I'm assuming a 33% tax bracket here because the thing about this, you guys, if I have to bug the owner and say, I can do an analysis for you, happy to do it, doesn't cost you anything. I need this and I need this and I need that and I need that and I need this. What are they going to do? They're going to be like, no, it's okay. It's not that important. But if I make it simple for them and easy, then they'll say, yeah, go ahead. That sounds good. So I'm trying to not bother them too much. If it's a CPA or an accountant, I'm going to say, hey, what tax bracket should I use on this? And they're going to know, right? Most people don't know the tax bracket they're in. So I don't want to bug the owner too much or make them think, wait, why are you asking me that, or trouble them? So I'm just going to assume 33%. 18,000 times 33% gives me 6,201. So now the tax payable has been calculated, so I can plug it back in on the top. So now I can finish this column. Think about what we just did. That's all we did is we took the 170, subtract the 430, 170, 430, 170, 430, subtract the 127, 738 to get to my pre-tax cash flow. And then I jump down here to figure out that the tax payable was. And I went through that with you right here. And then now that I have my tax payable, I can plug that in back on the top and I can finish this column. So now I take the 42,692, subtract the 6,201, gives me 36,491 after tax cash flow. Then I add in my equity buildup, which is the amount of loan that went towards principal, so a certain amount towards interest, certain amount towards principal. And this was last year, so I'm going to get this off the mortgage statement. So the mortgage statement's real important. And then I'm adding those two together, and now I have 62,045. Okay. And that's how I do the seller's current annual operating return. Any questions on that? That's a little complex, isn't it? It's a little complex doing that. And I know the first time I saw that, I was like, oh my gosh, what in the world? So it's just a matter of just take one step at a time, just little baby step. Listen to the recording, come to the 3-day, pause the recording, say, wait a minute, NOI subtract debt service gives me pre-tax cash flow. stop. Then he said, come down here. Okay, so now come down here and do this part, right? Just take it step by step. If you try to go right to this, you'll never get there. It's just too hard to do that. So you just got to go step by step and be very patient. And then once you've done it once, it's like, yeah, got it, right? Then it's like, okay, let me do it again and again and again and again. And that's what we'll do in the 3 day. Everyone who comes out of that 3 days is pretty much like, okay, because they've done it multiple times. I mean, I'm not going to do it, we're not going to sit here and do it 10 times, but I'm going to give you homework and I'm going to go over it with you several times. So pretty much everybody that comes out of there goes, okay, I have a pretty good understanding of how to do this analyses. A little tough to follow. Yeah, I agree. All right. So you guys are doing good. So let me keep going with you here. I don't see any questions on this part. Now, what we're going to do next is just a net sheet. So do you guys all know how to do a simple net sheet? Meaning if I sell my property for 3 million, I think, yeah, 3 million, and I have closing costs of commission plus closing costs, and my loan is this much, my equity is that much. You guys all know how to do a net sheet, right? In the room. I'm assuming everybody in here knows how to do a basic net sheet where you can determine the owner's equity using some tool. It's fine, but you know how to do a basic net sheet. Whether you do or not, I'm going to go through a net sheet with you in the 3 day class. Okay, how I do it a little different, but it's just basically a net sheet showing them if you sell it for 3 million and your closing costs are this much and your loan is that much, your equity is 1,000,003. Okay, just a basic net sheet. Once I get their net equity, now I can plug it into here. Then what I'm going to do is I'm going to take and I'm going to slide these numbers over from the seller's current annual operating return. So I'm going back here, pre-tax cash flow, slide it over. After-tax cash flow, slide it over. Equity buildup, slide it over. Total after-tax return, slide it over. So I'm taking these numbers and I'm just going to write them down. After-tax cash flow, write it down. See what I'm doing? Just sliding it over. Pre-tax cash flow, slide it over. After-tax cash flow, write it down. Pre-tax cash flow, write it down. Equity buildup, write it down. Total after-tax return, write it down. And then once I have these numbers, I'm just going to divide them into the net equity. 42,692, plug in my calculator, divided by 1,000,003, 3.22. 36,491, plug in my calculator, divided by the net equity, 2.75. 25,554, plug in my calculator, divided by the net equity of 1,000,003, 1.93. 62045, plug in my calculator, divided by the equity, 4.69. So the big question here is this a good return or not? If the answer, what's your answer, by the way? Is a 4.6 a good return? What's your answer? I'm going to show you another example of this diminishing return on equity. Is 4% a good return? Yes or no? Or do you know? Maybe you don't know. It's fair if you don't know. Okay, so Blair says no. And then somebody else says, I don't know, or I'm not sure. It's okay. Okay. So if the owner says, hey, 4%, it's okay. I can't get a whole lot better than that, in other spots, unless I go in other spots, which I don't really want to go into. Well, then I'm going to say to the owner, okay, I'll tell you what, why don't we come back? I'll come back in 6 months, 9 months, and we'll take another look at it for you. Because your return on equity is probably going to continue to diminish. And then the owner's thinking, what? You're not going to try to push me or pressure me or close me for my $3 million listing? No, because you said that's not a good that return is okay for you. See, this is truly about consulting with versus selling. It truly is about putting the owner's needs ahead of my needs, right? wow, an agent, a broker that's not going to put the commission above my needs. That's what that is. On the other hand, and I'll be honest with you, it's not always easy to say, well, it's not the right time for you based on what you're telling me. It's not easy to walk away from a $3 million listing. But I've done that multiple times, and each time it's been a little challenging to do it. I'm not going to lie. But there's something about that. You know, you walk away, you do the right thing, you put their needs above yours, and then I come over here and I'm getting business from other places, and I don't know where it came from. It's karma, right? So it's the right thing to do, and it's a good way to do that. I didn't always do that, you guys. When I was young and doing 100 deals a year, all I cared about was deals and trophies. It was very kind of silly, and then you start to learn, well, put their needs above yours, right? And then the business will come, the referrals will come. On the other hand, if they say 4%, what? Gosh, I can get that in my money market account. How'd that happen? See, then what we do is we start talking about next steps, right? And then it becomes a logical decision. Here's another example of this, and then I'll see that there's a couple questions in there. Here's another example of this. This is the doctor scenario. So the doctor buys his property for $1 million, and the loan was 750, equity was 250, cash flow was 25,000. This is a real scenario. I call it the doctor scenario because it was a doctor that I got in front of. And the doctor, when I met him, by the way, first thing he says, Mike, I'll never sell this property. It's operating so good. Why would I ever sell it? And then I did the analyses and I showed him. Uh, so the value went from 1 million to 1,000,008. Loan went from 750, 650. Equity went to 1,150,000. Cash flow doubled. So think about how many people are sitting in this position. About 50% loan to value position, equity position, and they've got a lot of equity. They've got a lot of cash flow, and they're thinking this is great, right? Well, is it? Because when you do the shortcut, so I'm teaching you the detailed analyses, but a shortcut to this that you can take a look at on all your own investment properties, you should, is just take the cash flow divided by the equity, and it was 10%. Cash flow divided by the equity, 10%. Here, the cash flow divided by the equity is 4%. So you see what's happening here. The return on equity is diminishing. It's called diminishing return on equity. 10% went down to 4%. It's going to continue to diminish until the doctor does what? Until he sells his property and puts his debt equity back to work for him. See, that's a problem when you have a free and clear house and it's an investment property, is it's all equity and it's all sitting there not working for the money's not working for you unless you go, well, it's going up in value. Okay, sure. But you can't always count on that. See, depending on where it is. Uh, and in theory, I can take my $1 million, and right now it's I've got a 2 million, we'll just say value asset. I can take the million and buy a $4 million property. Would I rather own a $4 million property or a $2 million property? Well, probably a four, right? If my goal is to grow and grow and grow and grow and exit, then it's definitely the right answer. On the other hand, if my goal is to just live off this 50,000, then I'm good. I don't care about anything you have to say. I don't care if I can buy a $4 million building and that will help my return. It doesn't matter because I'm getting $50,000 a year. I'm good. I don't need any more than that. I'm fine. I'm good. I'm done. Don't have any heirs that I want to leave my assets to. None of that matters. See, this is why you ask great questions. At that 3-day course, I'll load you up, scripts, questions. I'll walk you through. Here's how you do this. Here's how we put the grid together, how we target people and go after them. Here's what we say when we approach them. Here's what we say when we get in front of them. Here's how we present this to them. Here's what we do if they say that's not a good return. Here's what you do. I mean, I'll walk you through all of it. I'll show you how to do all of it. But we ask great questions. We don't just assume anything, okay? So if their goal, think about the other thing that's happening here is when I buy real estate in the beginning here, they're paying mostly interest or principal on this deal. They're paying mostly interest. Well, the interest is the tax write-off pretty much, right? So in time, what happens, I start paying less interest, I start paying more principal, the value goes up, the cash flow goes way up, and it's just pushing down on my return, forcing it down lower and lower and lower until I address it. And by the way, once the doctor said 4%. Wow. Are you sure? It became a, are you sure about that type of thing? And then I had to validate it with his CPA. His CPA actually closed him for me. His CPA said, he's right, you need to do this. And the doctor literally took out his pen and said, hey, do you have the listing agreement with you? He signed it, initialed it, sent it, slid it back over to me and said, okay, go to work. Didn't question my $2 million uh, value, my 6% commission. He sold this property, got into 3.8, 3.7, and he's one of my best clients to this very day because of this concept. Uh, so this is a great approach. This is a great technique, a great strategy for getting listings. This is called diminishing return on equity, and it's logical. Once these investment owners understand what you're saying to them, it's not emotional. It's not like, yeah, well, kids in school and colors of carpet and paint. It's, is this numbers make sense or not? So this is a much more logical way to approach them with this. Uh, any questions on that part? It would depend on the location. Uh, I mean, not really though. I mean, what depends on the location, Julie, is if I say I'm getting a 3% return in Laguna Beach, okay? And my property's in Laguna, and I don't want to, and I say 3%, you realize you're getting 3% return, and the owner says, "Oh my gosh, it's terrible. I can get much better than that in a money market CD. Can I get much better than that in a lot of other markets? Absolutely, right? We can do much better than 3% in other markets, but the person would have to want to go to the other market. Sometimes I have owners, investors who say, I don't want to go outside of this little zone, this little pocket that I live and own and know so well, right? I don't care about the return. I don't care about, I can be doing better. I like this area. I don't want to leave this area. This is my area. It's my, where I grew up. It's my great granddad and my father's, my great great granddaddy. And by the way, it's hereditary money. I got it from them, and I'm going to pass it down to me, and I'm going to pass it down to my son, and hopefully pass it down to his kids. And, see, sometimes people don't care. And so if that's the response or that's the way they're feeling, and a lot of people are like that sometimes, they just have so much wealth, so much money that it doesn't matter, right? If someone's like that, well, then the area would matter. It depends on the location because they're saying, I don't really want to leave this location. But if I'm in an area and I'm like, wow, 3%, no, I'll go anywhere. I don't care. I just want to, within reason, I just want a better return. Well, then I'm going to come and I'm going to show them what's called a side by side. So I'm going to show them, here's the numbers on your asset. Here's the way it's performing. And how's it look to you? 3%, is that okay? Yes or no? And if they say no, I'm going to say, well, here's some other examples of where you could be getting this kind of return, and here's another example where you could be getting this kind of return. So I'll line up the other properties that are available to give them some examples. So I'll show you guys how to do that as well. But that's a great question. I'm going to get you guys this 3-day content. So you've got it and you can register for it if you'd like. I won't go through a big long pitch. I'll do the short version of this. Take a snapshot of the screen of the date. Michelle, are you there? If you're there, get ready to drop
Michael.
this. Yeah. Hello?
Yes, Michael, I'm here.
Okay, good. Get ready to give them the promo code and the Orange County deal. Uh, so take a picture. It's August 25, 26, 27. We're going to cover a lot, but I don't want to go through it all with you guys because if you're not interested or it takes too long, then I don't want to do a big long pitch with what we'll cover in this 3-day class. If you have questions, reach out to me or Michelle. You've got our email, you've got our website address, and then I'm happy to get you all the specifics of what we're going to cover in this class. So I'll save you time. I won't want to do that right now with you. And then we're going to get into proposals. I'm going to show you how to do setup packages, marketing packages. We're going to cover that. We're going to get deep into the grid system because I need about a day and a half, 2 days to really show you where you find property owners and what you say to them and what you send to them. I mentioned we do a lot of stuff off market in commercial real estate. So I need to have that conversation with you in the 3-day class, how we handle these off market listings and pocket listings. And most importantly, what you do to protect your commission. Because if it's off market, we can't just market it and advertise it. So I'll have that conversation. I'll give you documents like our confidentiality agreements or NCNDAs or LOIs, things like that. I'll give you my copies so you can customize them uh, in the class. So we're going to cover quite a bit in the class. It's a full jam session. These are things that you get in the class. You get 3 full days of instruction. We give you a manual, digital or book, whether you go live or in person. I'll give you both options here in a minute. We give you a designation. So the manual we won't go through in detail in class. It's just way too much content, but it's always something you can reference back. Two, we give you a designation. The designation is really recognized now because we've been doing this for so long. Excuse me, the National Commercial Real Estate Advisor. Now you have to be there for all 3 days, and sometimes people will go 2 days here and 1 day there. Uh, Michelle tracks it, and when you're there for all 3 days, you get to earn this designation. We have an open book test that you have to pass, so we'll help you get through the open book test. But once you've done those things, you get to earn this designation. You put it on your letterhead, on your business cards, on your website, on your email templates, so that you look like a professional commercial broker. We've thrown in all these bonuses here, software we give to you. We give you a bunch of different tools, forms, contracts, a bunch of different lenders that I know in commercial real estate, a copy of my listing presentation. We give that to you. Uh, and the dates I've given to you, if you were to go to our website, you would see the cost of the course is $11.95 for all 3 days, $11.95 for all 3 days. But we're giving you the Orange County Association of Realtors half price deal. So there it is. Michelle will drop the link in the chat for you. You can just click it and register if you're interested in doing that. You can bring guests for free as long as they're not in this room. But now it starts to get real reasonable, right? Because now I register and then I go get a guest and they pay half. That's very affordable, very reasonable for 3 full days of jam-packed content. I won't go in all this stuff. There's a ton of bonuses I won't bother with right now. If you have any questions on what's included, just like I say, reach out because all this stuff is included as bonuses. There's the dates again. Now, if you can't make that date, take a screenshot of this because here's some other days and times. We will add days and times. We're probably we do this, every month, every other month. So if you can't do it this year, that ticket that we're giving you is good for the next 24 months. So you can apply it to next year or any of our other classes that we have. You can see August, October, these are virtual 10 to 6 Eastern Standard Time. So yeah, a little early for the West Coast because we're national. So we have all kinds of people in these rooms from different states. November, I'll be live in Long Beach. And that's really nice. That's a nice, convenient location. And it's close and you get the live feeling. I love live. I prefer live. It's easier for me to do this stuff live. It's easier to teach you and look over your shoulders when it's live. So I prefer that, but I also understand the pros and cons of virtual. I'm sitting here in my shorts, right? And didn't have any traffic, didn't have any of that kind of stuff. So I get it. But those are the options for you. If you can't get any of these dates, Michael, I can't make any of those. I'm busy, busy, busy. We'll just look to next year. We'll load up the calendar next year. You're going to get a ticket, and that applies for you for the next 24 months. Okay. Any questions on anything that we've talked about here? This would be a good spot for you to ask. Hey, Michelle, is this promo code? Let me show you guys this promo code. Is that
Yes,
expired?
Michael, yes, will expire. I put in until today, 5 p.m. Pacific Standard Time.
Did you say 9 p.m. or what did you say?
5 p.m., Michael. 5
Right.
p.m. Pacific
Okay.
Standard. Yes.
Okay. So what she's done there is you can see I'm sharing the screen with you. All you do is you click the link of any of those classes that you're interested in, and then Michelle, give me this promo code again because I can't see the screen right now.
The promo code, Michael, is the NCREA.
All caps. Okay. So you see what I'm doing? I'm just typing in the promo code, and then that price goes from $11.95 when I click apply. Michelle, did I do that right?
The NCR. Hold on, Michael. Let me check. 1 second.
Any other questions? She's gonna fix that, and then when you put in the promo code, it'll go to half price.
Just
for you.
refresh the page, Michael. Try it again.
Okay, refreshing. So you just put the promo code in there, click apply. Good. Boom. There you go. Half price. Okay. So that's good until 5 p.m. today, Pacific Standard Time. And then the half price and all the bonuses will go away. And it'll go back to the $11.95 deal. All right. So let's see. That's how you take advantage of that. Now I want to say something to you guys. And then I'll just open up any final questions here. If you're not quite ready for a 3-day class, consider our 1-day class. We've done them there at the board with Elsie. We've done our 1-day courses several times. It's 10 to 6 Eastern Standard Time. Next one's coming up is July. And that's a little baby step. So if you're in the room and you're like, I don't know if I'm ready for this big 3-day, I'm not so sure. Fair enough. Jump into the 1-day. It's like, what is that, Michelle? $64, $64.97 or something like that. And that's coming up. That's
$64.97. Yes.
$64.97. So give them the link to that if you didn't. You can just jump in there, right? If you're not quite ready for the 3-day, okay? I'll tell you what I'll do. Michelle, we'll let anybody who registers for this 3-day class, anybody who
Okay.
gets it, will automatically get entrance into the 1-day class for free. Okay.
Okay.
So if you guys want to jump in the 1-day next week, it'd be great to have you. You're going to love it. And it's you do this class today, you practice, you go into the 1-day course next week, you jump to the 3-day class, you're going to be in really good shape. That's why I'm giving it to you for free if you register today. Okay. So you get all that stuff if you take advantage of it today. Anybody can reach out to us if you have any questions or want more information at any time. And other than that, I'm just going to look for final questions. We did a great job of getting through this pretty fast, actually. I don't see any questions anywhere. Last call before we wrap this up. Will I be able to attend other dates with the same? Yes. If you have, Julie, the ticket, if you purchase it and you registered, that ticket is good for 12, we'll say 24 months. It's good for the next 24 months. So you'll be able to use it for another date. But if you don't take advantage of it today and then you come back later and say, hey, can I still get that deal? The answer would be no. It would be back to the regular price. And hopefully you're going somewhere fun on vacation. Will be recorded. Yes, of course, we'll record it. The difference is if it's live, I don't usually record the live version, but the Zooms absolutely will be recorded and sent to you afterwards. All right. How was this for you guys today? Was it okay? I know it's hard sometimes, hard to follow on Zoom a little bit, but how was it? Was it all right? How do you guys feel about numbers? Before you gave me your numbers, how do you feel about your number now at the end of the day? Let's just see if your number went up. Hopefully it did a little bit. So put your number in the chat if you don't mind. Scale of 1 to 10. Good, Julie. Yes, went up. Nice. Need practice to be a 10. Yeah, that's exactly right. Need practice to be a 10. Yeah, good. Thanks. Well, good to hear that. I'm glad your numbers went up a little bit. What do I need to do to get to a 10? Where should I be? A 12. How do I do that, Michael? Well, I keep telling you, you practice, right? Practice the exercise that I'm giving you in here today. Do the work, right? Spend the time, block it out. It's almost like your CE credits, right? What do we do with CE credits? Oh, I know I got to do this or my license is going to expire, and I wait till when the last minute to do them, right? And but just time block it and get it done. Practice, practice, practice. Take the 1-day class, take the 3-day class, come do this class again. We do it all the time through our company. And in no time at all, you're going to be going zip, 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 and you're going to be texting, emailing, calling, saying, Michael, I just closed a $10 million deal and I got my first $250,000 commission. Thank you so much. It's great, right? What would you do if you had an extra $250,000 right now? What would you do with $50,000? You know, it's a lot. It's a very significant amount of income that we can make in this industry. So it's well worth the time and energy if it's something that excites you. It's got to fire you up though. Like when I did this, I was like, oh my gosh, this is so me. I can't wait to get into this more. So it's got to fire you up and excite you. All right, you guys, that's it. Uh, Elsie, are you still there? You want to close it out? Thanks, Michael. Listen to you on our YouTube channel. Nice. Okay, so that you can see where she's going to record or post it. All good. Elsie, thanks so much. I appreciate you as always. You're a rock star. I hope everybody appreciates how hard you work to put classes and things together for them. You guys, thank you so much for your time. Have a great night and a great afternoon. And we're looking forward to seeing you at the 3-day class. Okay, or the next venture. Have a great night.